Last few days are tough for traders in general. Falling markets can definitely create a lot of panic in portfolio as well as in mind. The war tensions, increased volatility is not at all simple to handle, and at these times traders really feel helpless. And the result is panic or sell in loss or gamble to buy heavy price puts to save trades. I'll say preparation is better than panic, but yes, easier said than done. And this is also the fact that some of the biggest profits are made by traders in market falls or market crashes. The possibility in derivative markets makes it totally different from simple buying and selling of stocks. Whether you're trying to capture some profits in market fall as a new position or you're trying to protect your existing sold puts with low capital investment, bear put strategy is really great in both the scenarios. Welcome to another video by the Option School, and I am your friend Pradeep Singla. Disclaimer: all the content of this video is purely for educational purposes and no recommendations at all. Let us quickly see what kind of trading options we have in bearish markets or falling markets. Two simple options are there. Buying a put will surely capture fall in the market and give profits. Similarly, selling a call is also a good trade to capture fall in the market. But both of them have issues. Nobody knows how much market will fall or how long it will fall. So the risk in buying naked puts is huge time decay on daily basis. Plus, in case of a reversal, there can be a very fast loss. Similarly, in sold call, margin requirements are high. Plus, not easy to handle in case of a big V-shaped recovery. Loss can be unlimited. We definitely need a trade with better control, because once we have taken the trade, nobody is sure that market will continue its fall or not. Any panic adjustments can lead to further loss only if the trade is not in our control. Bear put spread strategy ticks all the boxes in such a scenario. Capital required is low, risk is limited, and in case of big market reversals, you do get time to almost neutralize the risk taken. Very good risk reward ratio and quite easy to understand and execute. Best part is it can be used independently to capture downfalls or can be used to hedge your existing losing positions like some naked puts. Please hit the like button for better visibility and reach. I am really thankful for each and every valuable like. So let us understand bear put spread. It's a two-legged option strategy. We buy a put and we sell a lower strike put simultaneously. Bought put gives profit on fall of market and sold put acts as a subsidy to cost of bought put, reducing the cost of bought put. Margin required is around 35 to 45k depending upon the difference between bought put strike and sold put strike. If the gap is more margin will be required, and if the gap is less, only 35k will be required. Let us see how it is better than a naked put buying and how it can be used as a very effective tool. Let's see this payoff diagram. In this case, we have purchased a naked put. It can cost us, let's say, 27k. And in case market reverses with some sudden news, major portion of this can be lost because speed of loss will be pretty fast. Even if market doesn't move much, stays there only, still there will be a decent daily decay in terms of theta, which is very high, 432 rupees. In this case, we have created a bear put spread. Max loss is whatever debit we have given, in this case around 7k. Even in sudden reversal of let's say 500 points also, max loss is far less compared to a naked put. Again, for clarity, margin required will be around 40k, but once the position is scared off, you will get your margin back minus the loss, and this loss can also be nullified. I'll show you how. And if we see theta decay daily basis, it is almost 1/10 to 1/9 of naked put. So if we see one-to-one comparison, much lower theta in bear put spread, that is a daily loss. Max loss is much less, is limited. It can be further reduced also. Best thing is it requires a much lower fall to give profit. See the break even point after which profit will come. In case of bear put spread, it is 25,596, whereas in case of naked put, it is 25,336 in the same example. So the question is always, what is the profit potential of the trade and what is the risk taken. Risk taken should be less, profit potential should be substantially high. Few other interesting things to keep in mind for bear put spread. It can be used as a hedging tool for your other trades at a very low cost. Why I'm saying this? Because buying a naked put as a hedge when implied volatility has already increased, it will be a very costly affair. When you are using it as an hedging tool, you can definitely position it above sold put. Say you have a bleeding put of 23,500 because of fall in the market. You can place a bear put spread of maybe 23,900, 23,600, and it will act as a protective shield for that naked put. Since it is low cost and it is a spread, it gives time if market starts remaining flat because theta is low, or even in the reversal, trade can be removed at a small loss and original trade obviously will also give profits. In case of reversal, you can convert this trade to put ratio spread also and remove all the debit. That's a very good adjustment for this. But obviously with caution. I am leaving you with the put ratio spread video. You will find its part 1 and part 2 very useful. If this video helped you, please hit the like button and also hit the subscribe button. We will share more details of such adjustments for our silver members. If you have not joined that membership, you can think of joining that silver membership for some exclusive videos. See you in our next video. Thank you.